Hi, everybody. Thanks for joining us. My name is Adam Ayer. I'm branch manager at Wells Fargo Home Mortgage. Linda Zhang, one of my HMCs. She has the connection to the office and got us in here. So basically today we're just going to talk a little bit about the markets overall, financial markets, mortgage market, discuss a bit about retail banking versus mortgage banking and mortgage brokering, just to provide you information essentially that can help you in dealing with your buyers, and better understanding of kind of what's happening in the industry right now. You say anything? Keep going. You say anything? Yeah. Okay. So here's kind of a table of contents. We're talking about mortgage industry, changing landscape, retail banking versus mortgage banking, financial constraints banks have, interest rates, and Wells Fargo competitive advantages, case study, and then the watch out is a good one for agents. It's kind of things that we see that make it harder to get a loan through, that come through from the real estate side, escrow side. So just a little heads up for you guys when you're writing contracts. So let's jump into mortgage industry and changing landscape. Inflation is main concern. So as I'm sure you've all heard, inflation is the big, headliner these days, and is driving where interest rates, for the most part, where interest rates are heading. So we've had a Fed that's been raising rates to counter inflation. They're hoping to see job losses. To them, that would mean that we're on the deflationary path. But at this point, there's been pretty strong economic data. I personally, and I'm not a financial advisor, personally, I feel like we're getting to a bit of a wall for the consumer, and consumer drives 70% of the economy. So consumer debt is way up. Consumer savings is now way down. My personal opinion is that, consumers have had a lot of money that came up through COVID that they've been spending, and that's kind of drying up, and especially with the inflation we've had. So my thinking is, in my opinion, we're going to see rates start to do a retraction towards the end of the year into next year as we get more data that supports a slowing economy. The market, in my opinion, overall is looking for that data. At the beginning of the year, every piece of data that came out, almost like the institutional investors were looking for it to signal higher rates. And I feel like now they're looking for data to support a shift. So, we've had things. Did you post yesterday's data from? Yeah. Okay, let's see here. Let me go one ahead. Okay, this kind of shows current unemployment rate. So that went up 3.8 to 3.8% last reading. If you look at the employment numbers, when we get the monthly employment job creation numbers, it's been fairly strong. I think last month's reading was 187,000. But if you look at every month prior, they keep reducing them. So they revise them lower. So I think the last 2 months were revised 100,000 jobs lower. So the weird trend right now is that we get the job numbers out, they look really good. When the next month job numbers come out, they revise the previous job numbers down. So it's a very interesting. I don't feel like the market's really taking that in yet and reflecting in what's going on, like in the stock market, for example. So it's interesting. We got to keep watching and follow the data. So we go to the next slide here. Unemployment rate in California, 4.6%. Total unemployed people, 885,000. Obviously, right now we don't have a demand issue in California, specifically Bay Area. We have an undersupply issue of homes and people who want to buy, so that's not affecting us really. So retail bank versus mortgage bank. So this is good to understand a little bit. So retail banks, Chase, B of A, Wells Fargo, Citi, have large deposits from customers, right? And that's the cheapest way to lend. So if we can lend as a bank, our deposits, which we pay, I think Wells pays maybe up to 1%, but most of them are under 1%. If we can use that to lend, specifically for our jumbo products, because in the jumbo world, which is mostly going to be Bay Area, is mostly jumbo loans. So anything over 726,000, I think it now is going to be a jumbo loan. And that just means that the banks can't sell that to Fannie Freddie. It's not liquid. They have to keep the loan on their books. So they typically have more stringent guidelines than a conforming loan, which is Fannie Freddie Mac. Those are guaranteed by the government. So those can be sold in the bond market easily, because if the borrower doesn't pay, the government pays the investor back. So the jumbo products are a bit different. So they require, but the key to the jumbo product is that the banks are lending their own money. So what we've seen this year, especially with SVB and First Republic, where those institutions lent a little bit too much of their deposits out. First Republic, I'd argue, had a good business model. They just got sucked into what happened to SVB. But they were lending, First Republic was a huge competitor of ours. They were giving very low interest rates because they're using their deposits, which is the money from the customer. They're not borrowing it to lend it out, they're just lending it out. And that was very effective for a long time. But what happened was, after SVB went down, banks had to reanalyze how safe is it to lend out how much of our deposits? And you're seeing institutions like Golden One, that was also a very big competitor of ours, basically step out of lending portfolio money because they didn't want to get in trouble. They didn't want to put anything out in the market that there might be an issue with their reserves, because that's what caused the run on First Republic as well. So the climate right now with the higher rates, institutions that aren't going to be lending out their deposits anymore have to borrow from the Fed, which is much more costly. And so again, the biggest difference between a retail bank like a Wells, Citi, Chase, we have large deposits that we can lend out, which provides us the ability to give much more competitive jumbo rates. A mortgage bank like a Loan Depot, a Guild, guaranteed rate, fantastic operations and business models, but the difference is they don't have their own money to lend. So they ultimately go through a correspondent channel to one of the banks or different investors. But it's a great business model. It's just different. It's trimmer, slimmer, quicker, less regulation, but you're not typically going to find as competitive jumbo pricing through a mortgage bank that you will through a retail bank. And that's the big difference. The lending deposit is the key. So if we have deposited money to lend, it's a very cheap way to lend, and that gives you the stronger jumbo pricing. It's better to go with a local bank for a mortgage. A local bank with a good reputation is a sound choice. So yeah, local bank that a lot of the effectiveness in getting a loan, as you all probably have been through, is many times how good the loan officer is, because the bank's gonna have certain guidelines. So if you go to B of A, Chase, Citi, Wells, we have general guidelines that are similar, then we have ones that are very different from each other. And so obviously you want someone who's very experienced looking at the file, because they may miss a guideline that's there and they just don't know. And then at the end of the day, it pops up and it's a big problem. And we've all probably been through that. So that's important. Financial constraints, I kind of talked about this. Banks come to a level of lending under deposits versus borrowing money from the Fed to lend. Lending deposits is the cheapest way to lend, but they have realized they need to keep a large portion of the deposits. One of the reasons for that too is a lot of these banks hold long-term bond portfolios. Okay, they invested a lot of their money into bond portfolios when the rates were very low, prices were high. As the Fed starts raising rates, and they did it the Fed took rates too low through COVID, and they raised them too quickly, too high afterwards. So dramatic effects. And that's really what killed SVB, was they had a large bond portfolio, and as rates rise, okay, the prices on bonds fall. They work inversely. As the rate goes up, the price goes down, and that created a very, very large unrealized losses on the bank. Okay, and so what's happening now is a lot of these institutions that have long-term bond portfolios that are valued very low, they have to be very careful on how much they lend to their deposits, and that's what's been going on. So as we see rates turn, which I hopefully think we're going to see towards the end of the year, values of those bond portfolios will rise, and that will actually provide more liquidity to a lot of the institutions to start lending again. It's going to help everybody. Okay, so this is the 30-day SOFR. So SOFR used to be LIBOR. You guys probably heard this if you heard loan talk and stuff. LIBOR went away, and so SOFR is the new index for ARM products, 5, 6, 7, 6, 10, 6 ARMs. Those products are fixed for, if it's 5, 6 ARM, it's fixed for 5 years, then it's going to adjust every 6 months after that. The index we use is the SOFR. So the SOFR is at 5.3% right now. If you go back 2 years ago, those indexes were 0.8. Okay. So now what happens is, if a borrower wants an ARM product, okay, and let's just say the 7.6 right now is 6 1/4, 6.375, they're qualifying at 8.5% or 8%, because we qualify off the fully indexed rate or the note rate, whichever is higher. In this case, first time in a long time that the fully indexed rates are higher than note rates. In a falling rate environment, you're usually going off the note rate, because that index is falling like this, and so the qualifying rates or the fully indexed rate is lower. Right now, the fully indexed rate is much higher. So for customers that want ARM products, and they see 6.3%, they have to qualify like 8, and that can make it more difficult to qualify. Where if you go to a 30-year fix, we just use the note rate. So those are discussions we have with the customers all the time on looking at, okay, you know, what's the product you want versus what may work to qualify, and what's the spread on that. Right now, the spread between the 30 and the 7.6 is maybe 0.5%. What do you say? What's the 30-year high sixes and or 7? About 0.25%. So that's another thing to analyze with customers too. We talked to them about is what is the spread between the cheapest product rate, the rate with the cheapest product, and the most expensive. Right now, it's pretty close. I mean, we had times a couple of years ago where the 30-year might have been 1% or 3/4 higher than the ARMs. So the ARMs were very attractive to customers. Now you don't gain as much by taking an ARM versus a 30. So it's a good thing for the market and for borrowers. Any questions on that? All right.
So there's no LIBOR anymore?
No.
Oh, okay. So
It might still be out there, but it's going away if it's not already gone away. I think it's gone actually.
what's S stand for?
It is the that's a good question. Overturns. Yeah, what is the S? No, yeah, it'll come to me. I forget right now.
No, the LIBOR.
Yeah, LIBOR, SOFR. So SOFR is the new index. LIBOR was the old one. So yeah, US 10-year Treasury. So this is a great index to follow if you want to know what mortgage rates are doing. The 10-year Treasury yield, okay, kind of mirrors mortgage rates. If you see the 10-year Treasury yield, you can look it up at cnbc.com. You see that going down, most likely mortgage rates are going down. Those are fairly competitive products to each other. A mortgage and a 10-year bond, Treasury bond, are kind of like assets in the marketplace. So that's a good index to follow if you want to know what's happening with mortgage rates in general. They're not going to be the same as this, but if this is going down, mortgage rates are typically going down as well. And then today's interest rate, so jumbo 2.5 purchase, 2.5 million purchase, 20% down, FICO 800. We're looking at about 6.65% with an 8 point. There's the APR and the 30-year. So look at this, an 8 difference basically between the 30-year and the 10.6. So obviously, like, you know, borrowers can be very picky about the rate, but you only gain an 8 lower interest rate and give up 20 years of fixed period. You know, so that's where you know, a lot of borrowers are maybe moving more towards the 30-year fix in that situation because you don't gain that much by going with the ARM.
Yeah, most of the time, the ARM and the 30-year fixed difference is only 0.125%. But with 30-year fix, the borrower can borrow a lot more money to qualify that.
Because instead of qualifying at 8% here, they're qualifying at 6.75. So there's much more buying power right now for a borrower with the 30-year, and they don't give up much in rate as well. Like I said, a couple of years ago, this spread might have been 0.75%. So that's a tougher argument because the borrower's like, this is a much lower interest rate. Why would I take a 30? So yeah, it's very interesting right now. Okay. Let me go through these again. Okay. Okay, so Wells Fargo competitive advantages. So again, we're not going to be the right place for every customer. That's the fact. There's going to be other retail banks that have a certain product or a certain guiding that fits somebody else differently and better. Or there'll be some customers that fit into a mortgage bank model versus a retail bank model. But these are just some of our, I would say, competitive advantage of ours. Let's see. Primary wage earner FICO is a difference in the industry. No one else does primary wage earner FICO. So what that means is we use the FICO score of the primary wage earner on the application, not the lowest of the two. Every other lender in the industry uses the lower of the two FICOs. So we have a tri-merge report, so 3 credit scores for each borrower. And typically you take the mid score and we will take the primary wage earner FICO. So if you think about it, if you got a customer that's getting declined or getting horrible pricing because the lower of the two is 720, but the primary wage earner is 800, we're going to use 800 FICO versus 720. Big difference. So that one right there could save deals. If you have loans being declined or the pricing just so whacked out because one borrower's got a very low FICO, yet the other one's the primary wage earner with a good FICO, that's a big one in the industry.
Question. When you pull the credit score reports, did you just pull from one company or 2?
We have 2 or 3 that we pull from, and our system randomizes it. So we don't pull from just one company for every credit report. Think CoreLogic, Equifax, Yeah, but the companies, I'm sorry, the companies we pull, because we will pull an Equifax TransUnion Experian. Those are the three agent bureaus that we pull from. But who runs it? It's there's two that run it, and we don't get to decide which one. I think the system just does it randomly, so we're not using only one company for it, but it's pulling the same information. It doesn't matter who runs it, they're pulling from the three bureaus every time. So the bureaus are the ones that provide the information to us. So yeah.
And the score will be average or?
The score, so if you run it today, we'll get a score from Equifax, TransUnion, and Experian that day for that customer. And they're usually different, you know, because they have different modeling and formulas. And we'll take the mid score, mid FICO of those three. So the high, low, we'll take the one in the middle for both borrowers. But then when you look at, again, the primary wage earner piece, whoever makes more money, we'll use that FICO. So instead of always taking the lower of the two, we may get 50% of the time we're actually using the higher FICO because that particular borrower makes more money on the application. So that's very unique to the industry. DTI up to 50% of borrower has 4 times. So I think one of our competitive advantages is our ability to do exceptions on jumbo products. So while our guidelines may be here, we have a lot of eligible exceptions for the right customer. You know, so if we have a customer that's got a 48% DTI when the guideline is 43, we may be able to do an exception if they have 4 times the required reserves. So as a company, as an institution, we say, okay, while their debt to income ratio is higher than we like, they have a ton of reserves that would offset, something that could normally affect the borrower, where if they lost their job for a couple months and they had very little reserve, that's a big problem if their DTI is higher. If they have 4 times the reserves, we might look at that and say, okay, while the debt ratio is a little high, they have an exorbitant amount of extra cash in the bank. So we could offset that higher debt ratio and maybe make an exception. It's not a guarantee, but we have the ability to do that for the right customer. And then again, so properties owned, if we have someone with a lot of properties, we're going to require that they have 50% of the total financing in reserves. Again, what I do appreciate about our guidelines and our philosophy in lending is that we want to make sure the borrower can pay the mortgage. We're not just trying to do loans. So it's more of an underwriting philosophy. Can this borrower handle this payment? We look at their whole financial picture and say, is this the right thing for this borrower? So a lot of our guidelines are based on that. Someone who owns a lot of properties, we want to make sure that they have a solid amount of reserves to manage that through a crisis. We don't want to give them a loan and say, hey, yes, another loan, get out of here. Now you got 21 mortgages. We're going to look and say, can they handle this? Are we doing the right thing for the customer? Which I think is important. Only 3 trade lines. So for us as a guideline, we require 3 trade lines on a credit report. Okay. Most lenders require a certain length of time the trade lines are open, certain amount of activity in the last 12 months, and a certain amount of trade lines. We actually require 3 trade lines. So that is also a competitive advantage of ours, not requiring a certain length of time that they're open, a certain amount of activity on them, but just 3 actual trade lines. Stock value for reserves, we use 100% of stock value, so we don't discount it. Many lenders discount the amount, and we don't need to provide proof of liquidation of the stock account prior to closing, which helps too in paperwork. Many lenders will require the proof that you liquidated stock account that you're using for down payment. We don't do that, so that makes it easier. Our relationship discount pricing is very helpful in this market, in this area. So we have, off of the quoted rates, if you move $250,000 to Wells Fargo prior to closing, and it's not part of your down payment or closing costs, so it can remain there, you get an eighth off of the current rates. If you move 500 a quarter, 750, 3/8. You do $1 million, it goes to 0.75% off of the market rate. So in this area, there are, not surprisingly or surprisingly, quite a few individuals that can actually meet this and move the money over, and they get 3/4 off the pricing, which is amazing. Do you want to comment?
How did you determine it? Well, for example, if you move 1 million today and want to borrow next month.
So,
how long the fund is?
okay, so that's a great question. We don't have it written. There's no requirement written in the note or disclosure that you have to keep the money there for a certain period of time. We did that, I would say, 15 years ago when we first introduced the relationship pricing offer. And there wasn't a launch to the note that said, if you take this money out, then we're raising your rate back to what it would have been. I think there were probably a lot of legal ramifications and issues with customers. So the bank revamped and said, there's no requirement. We just have to establish in the application and through verification that you have enough money elsewhere for down payment, and you're gonna tell us, borrower, what accounts you're using. You tell us you're using your Schwab or Chase or B of A for down payment. So, and we verify you have the funds there, so we know the money can stay at Wells through closing. We'll give you this discount. Now, after closing, we have no clawback penalty written in, so borrowers can move money back out. I think what the bank found was that the stickiest borrower that left the funds there were the ones that did over $1 million. So they improved this pricing discount to capitalize on that because that provided the most value to the bank. There was definitely more movement, I think they found in this range. But at this point, we're sticking to continue to offer it, even though there are customers that will move it in, move it out. We don't have a requirement of keeping it there. We just have to establish they have the ability to leave it there and use other funds for down payment and closing. So case study. So yeah, FICO 620. So on our jumbo, we can go down to a 620. It's outside guidelines, but again, like I said, we do have the ability to do exceptions if it makes sense. So there's situations where a borrower had a 30-day late or has a collection of a medical bill they never got the bill for, and it's $600 or $200. Hits their credit report and their score drops to 650. Okay, our printed guideline for jumbo, I think, is 720. But we would look at that situation and say, okay, customers had credit cards, mortgages, they have no late, they pay as agreed on their credit report. Their FICO 650 because of this one incident. We would not probably hold that against them and probably do an exception on the FICO if it's a very strong file otherwise. That's where I say we have the ability. It's not like you're just locked out. You know, we have the ability to look at the situation and actually use common sense. Say this is a one-time issue. They've explained it, so we can get around that. You can use your departure home HELOC for a new purchase down payment. Don't want to sell stock. So this actually goes to two pieces, but yeah, so we can do asset dissipation. You guys may have heard that. So borrowers who have a lot of assets, but maybe not a lot of income, they've saved and invested and they have a large asset amount. We can do what's called asset dissipation, which takes the asset total and looks at it like a loan, and we use a 0% interest rate. So essentially you take their assets and you divide them by 360. You can use that as a theoretical income stream. Basically saying the borrower took this much money every month, it would last them 30 years. We can use that for qualifying. The borrowers don't actually get to do that. It's just a theoretical income stream based on the assets. So you have individuals with a high net worth, low income, maybe they're not working anymore or working, very little, but have a high net worth. We can actually utilize that to create an income stream for qualifying. Another also, tool for borrowers that we find a lot is those that have investment accounts with Morgan Stanley, Goldman Sachs, a lot of the institutions, E-Trade. They will allow you to collateralize your investment account. So rather than liquidate your stocks for down payment, you can actually borrow against them, not liquidate anything. In some cases, that's a great move for the customer because they may be in a situation where they're going to be able to pay it off in 6 months. So why liquidate? So if you have customers that are trying to move up the ladder in the purchase price, but they don't want to liquidate more of their stocks, that's always an option we talked about, is check with your financial institution. You might be able to borrow against it. And it's typically fairly cheap. And then you don't have to liquidate and pay taxes on cap gains taxes. So that's something to talk about too. H-1 visa expiring. So that's the situation. If it's expiring, we just have to make sure that they've applied for extension. Again, doesn't have to go through, but we have to make sure they applied for it. We now only need 1 year rental history for rental income. So that used to be 2 years. Industry standard is pretty much 2 year rental management or rental property management experience to use rental income for qualifying. We just reduced that to 1 year. Someone, like I mentioned, has over 10 properties. There's some additional reserve requirements there. Our cash recoup is a great product as well. This is for a customer that pays cash for a property, but actually does want to finance. Maybe it's a 10-day close and they've got the cash. They pay cash for the property. They can then do a cash recoup, which is cash out, but we categorize it as a purchase because if we can verify they've used all of their own funds, okay, not gifts from family, loans from friends. If it's their money, which we verified through bank statements, all that, then they can actually do a cash out after closing as a purchase, priced as a purchase transaction, which is a cool product to have. Because most other lenders would categorize it as a cash out refi. Cash out refi is priced very differently than a purchase transaction. So this is a unique product for us too, to be able to do that for customers.
And you do it within 90 days.
Yeah, if you apply within 90 days after buying property, not to close, but apply with us, then we can structure it as a cash recoup. Okay, these are fun. So watch out. All right, so Linda has in there new immigrant, new grad. Okay, so someone new maybe to the country, more so a graduate. For us, if someone's right out of school, okay, and they don't have much history in employment, we look deeper at those files as an institution. We want to make sure again that we're doing the right thing for the borrower. They've been paying, you know, we have situations, they pay $2,000 a month in rent, they got out of school, super bright kid, they work for Facebook, now they're making $350,000 a year, they want to buy a $2 million home. We might be like, you know, so your payment shocks from $2,000, you're going to go up to $7,000 or $8,000 a month in payment. We look very deep at those. There's other lenders that would just say, well, if you meet the DTI, you meet the assets, done. We're going to look a little deeper to make sure that we're doing the right thing for this customer, that they can handle this payment. You know, so that's just for us something we look at. First time home buyer, similarly like that. It's a little more scrutiny on it for our portfolio, okay? Because we'll do agency conforming loans all day long, adhere to those guidelines because those go to Fannie Freddie through their policy. But for us, if it's our own money, we're going to look a little deeper in those situations just to make sure again that we're doing the right thing for the customer, they can handle the payment, and there's enough, you know, comp factors there. Employment history, bonus and RSU. Did you want to talk about how we use those basically?
We use a 2-year bonus.
Yeah.
We need to have a 2-year history of bonus. Can be combined of previous employer and current employer.
Mhm.
But you need to have it's called a performance bonus, not sign-on bonus.
Yeah, so that's to touch on that. A lot of companies right now, especially like in the tech world, they'll get a huge initial grant of restricted stock units. That's like one of the main compensation tools for the tech companies in the Bay Area. Is a lot of RSUs or restricted stock. You have a customer who's changing jobs quickly. The borrowers don't really get it because they go to Apple and they get this $1 million sign-on RSU grant that's going to invest over 4 years. And like, well, I'm going to be making $250 just from this every year is at best. For us as an institution, though, we know that $1 million grant's not going to continue. That's an initial one-time grant. Okay, the refresher grant is what the company is actually going to be providing moving forward. So as a company, as a lender, we want to see, well, what's your refresher grant? Okay, I think typically say if they're getting $1 million sign-on RSU, they're probably going to be getting 250 to 200 a year refreshers each year. That's what we look at for qualifying. So again, we're going to do what's right for the customer. If they're not getting $1 million every year in RSUs, it doesn't make sense to use that as your income. Okay, there's other institutions that will actually use that. I don't think that's very responsible for the borrower, but that's just what they do. So in those situations, we have had deals that have gone elsewhere because they're going to use that initial grant and calculate income based on that, which makes no sense. So for us, we want to see what is your refresher. If you haven't had a refresher, we're probably going to look at your historical income at RSUs. Have you had them before at a previous company? What were they? What have you kind of managed off of in the past? So we look deeper in those situations, but it's, in all honesty, like it's good for the customer and the borrower to put them in the right position for their purchase. Yeah, this is good. Okay.
So you may be very careful with your contract. When you write a contract, there are some sections like report who pays for what. If you mention any report name on it, the lender is going to check. They will say, hey, bring me the report. I want to take a look. But the report, no report will be 100% clean, right? Then you will be getting into the loop that the lender will ask you to fix everything before lending. So that's a watch out for you.
Yeah, just to be, you have to do the right thing for your customer, obviously. So you need to put what needs to be put in there. But from a lending perspective, if we see termite report or mention of, flooding in the house or something, we have to ask about it. We have to get information on it. So it's good for you to know as you're preparing the contract, putting in, termite inspection, repairs in the contract as they may need to be in there. Just be a heads up that it's going to come up for the lending side, because we have to make sure that the property we're lending on doesn't have any health or safety issues. That's a responsibility of the lender. So it's important just to know when those are put in there that we may have to address it, and it may come up. Yeah, I mean, no, okay, yeah. And then rent back 60 days. So for us and in the lending world, a primary residence property, if the borrower is buying as a primary residence, they're gonna occupy in the deed of trust within 60 days. So rent backs need to stay at 60 days or less, otherwise it causes an issue because then that property is not technically a primary residence based on the deed of trust. So when you need rent backs, we want to cap them at 60 days. I would say opening new debt, obviously, good to talk to your buyers through the process before they come to a lender even. You know, if you're looking to buy a house, you want to think about what you're buying in the near future. If you're buying a new car, you know, taking out a lot of credit card debt, that could affect your buying power down the road. So just good to have that conversation with them. Give funds overseas. So for us as an institution, what's the word? On the banking side of Wells, we want to make sure there are certain countries that have capital flight laws, okay, that allow individuals to send a certain amount of money out each year to their families. So for us as an institution, we want to make sure that we are not aiding and abetting individuals to skirt that system. So many times when we've got foreign gift funds coming in or funds from foreign accounts, we're going to ask for the documentation for those accounts overseas to verify, to basically source it. That's just good to know when it comes to Wells Fargo. Other institutions, it can be different. For us, it's just to highlight if you have a customer you know is getting a lot of gift funds from overseas, just it's not a red flag, it's more like note it, and that may be something that we have to, through Wells Fargo, document, basically. And then, yeah, I mean, mold, I know mold's a big issue. So for us, if there's anything that indicates possible mold, whether it's in an appraisal or in a contract, that is going to trigger a mold inspection. So that's just another one we want you to be cognizant of in the situation. Mold's a big red flag for us in the lending world as well. So anything that may appear to be mold, or is mold in an appraisal or in the contract is definitely something that we'll have to get a mold inspection. So that's just another FYI, kind of watch out for. Anything else in there? And then there's Linda's information. Any questions on all of that? It's a lot of information. No? Yes.
Just a little bit curious about the gift funds.
Yes.
For gift funds, if you receive like a large portion of money out overseas, how does the tax go?
The taxes? Well, that's so talk to a CPA, but so it's more, yeah, from the lending side, if we're more focused on what to say, you could have, so if a country has capital flight laws, you can only send a certain amount out, right, to your kids. What will happen is parents will send money to another family member of the country and they'll send it over to the kids, okay? We want to make sure we're not participating in that transaction because that could be seen by our government as, you know, we see it as an issue. That's why we would ask for, if you have many times overseas gift funds, we're going to ask for the bank statements of those gifts or where the funds came from to verify that there's not any intermingling or we call it structuring of funds to get them over here. If there's not, it's fine. It's not a big deal, you know, but if there is, we're going to say, no, we can't use those, you know, because you're skirting the country's capital flight laws to get the money over. And that's kind of, we look at that very in depth, you know, and not wanting to participate. And that's kind of where we come from. The tax purpose, I wouldn't be able to really comment, you know, CPAs would be better for that. Yeah. Yes.
So I have a client, he's getting about 50,000 RSUs.
Okay.
About 50,000 shares, but only 20,000 shares are vested.
Uh-huh.
But 30,000 shares, you know, every year.
Yep.
So you still have 3 years to vest the other 30,000.
Yes.
How do you look at that? Do you look at it as a whole lump sum?
No, it's a great question. Yeah, great question. So the vesting of the RSU is the taxable event. That's when the customer is going to report on their pay stubs. So if you get like, I'll make it easy, let's say 100,000, usually the companies do a 4-year vesting. So 25,000 each year will vest. As they vest, that's the taxable event that shows up on the pay stub. And that's what we look at for qualifying. Now, what we want to see is, has the customer had, you know, two grants, so in 2021 and 2022, if they had two, what are the values of those grants and how are they gonna vest out? And what will usually happen if we keep it simple, if they're getting, on average, 100,000 a year worth of RSUs that then vest out over 4 years, we'll probably end up giving them $100,000 in qualifying income per year, because that stacks up on itself. And essentially, I guess the easiest way to look at it is, it's kind of like a bonus where we're gonna look at your historical bonus earnings, okay? And if you get 75,000 or 100,000 each year in bonus, we're just gonna average the last 2 years and take that, over 24 months and use that as a monthly amount. RSUs are, to a certain extent, the same. If you're getting a consistent amount of RSU grants per year, because you get your grant and then it vests over a certain period of time. If those are consistent, it's gonna most likely be a 12-month average of that annual amount, and just divide over 12. When it gets a little squirrely is if someone just left a company and they were getting a certain amount every year of RSUs that vest over a 4-year period. They go to the new company and they haven't had their first annual refresher. We don't know for sure what that's gonna look like. They may have just gotten their big initial grant, which is usually 4 or 5 times the size of what they're gonna get moving forward. That's where it gets a little squirrely to calculate and come up with what we call a stable income. In the lending world, we want to create or use stable income, stable employment, things that we can kind of count on to be consistent for the customer. And the variable income pieces is where it can be a little quirky. So like bonus, commission, RSUs, those are all variables. They're not like a salary that is consistent every month or annually. So we're gonna try and come up with logic to what we're gonna use, and it's gonna be what's most stable. And so to your point, it's gonna be more about how much are they getting per year in value, and how does it vest? Does it vest out 3 years or 4 years? Is it spread out further, or is it kind of consolidated? And that all kind of plays, and we actually have an RSU calculator. So when we get a customer, it's not guaranteed, but it's pretty. If we got all the information, we punch into that calculator, we pretty much know what we're gonna use for qualifying, which gives you certainty.
You have a certain formula.
Yeah, Wells Fargo came up with a formula. We punch into a calculator. It looks at historical RSU earnings. It looks at it will give some credit from an initial grant, which is usually much larger, and then it will take the recent annual refresher grants and spit out a number that's kind of the most stable number to use for us. Yeah.
Yeah, the future vesting units matters,
Mhm.
and the stock price. We look at the current stock price and the last 2 year average stock price.
Yeah. Yeah, so that's another, we're a bit conservative in a sense too, is we'll take the lower of the two. The 2-year average of the stock price or 70% of the current price. So we're gonna discount a little bit, but again, it can be frustrating for a borrower at times, but the bank, has weathered storms like 08 and other crises pretty well, because we really are in depth in our analysis in providing loans to borrow. We want to make sure the customer can handle through a crisis this financing, and not give them something that's, one job loss and they're out and they can't pay their mortgage, now they lose their house. So that's why we do these things and get more conservative in certain ways. But at the same time, for the right customer, we can go outside of our guidelines too, with an exception. So every customer is their own situation that we look at and try and come up with the right path for them, let's say.
Some lenders requires, the tax return. What's the reasons behind that? If the customer provides you W-2 or paycheck and bank statement.
Great question.
But it still requires.
You're right. Okay, so I will say this. In the mortgage banking world, like I mentioned, guaranteed rates, those places, many of the underwriting guidelines that they get from their correspondent jumbo lenders, and I was in mortgage banking, so I know this. A lot of those institutions require 2 years tax returns. It's part of the package, so in that world, mortgage banking, it's going to be asked for more often, even if you're not using income that you need from a tax return. So tax returns will provide you, if a customer owns their own business, you need tax returns, because that's where you analyze the income. If they have rental properties, you need tax returns. That's where you're going to see the rental income that they've documented or disclosed. If you have W-2 wage earner, you don't need tax returns because that income is through a W-2 and a pay stub. But if you're going through like mortgage banking, I will say most of that time, they will ask for tax returns because it's just built into their guidelines for some reason. The investors want those on every loan. Wells Fargo does not require it if we're not using income that we need from a tax return. So W-2 wage earner, we don't ask for tax returns. It's only if we find out they got their own business, that there is rental income, they own a property, and they need the rental income to qualify. But if we're not using rental income to qualify, even though they have rental properties and they have W-2 pay stub income, we don't need tax returns. That's also conversations that loan officers have to have with the customer ahead of time is, hey, you don't need to send me everything. Like, wait till I tell you what I need. Because sometimes that does open boxes that you don't need to open with that information, too much information, right? So good to have communications with the customer and loan officer, what exactly we need for qualifying in the situations. Great question though. Yes.
Is there an advantage of, I mean, you know, Bank of America, you know, Chase, and all these major companies that your competitors are
Yeah.
with. Any advantage on Wells Fargo versus others as far as you could tell? Because for a lot of us that haven't, you know, worked with buyers or whatever,
Yeah.
you know, we see them as the same. I mean,
Mhm.
what it was 5 years ago is different today. So as far as you could tell.
Yeah.
Can you just summarize what's the advantage of Wells Fargo versus
So-
those other major competitors?
And yes,
Versus-
absolutely.
Credit union, because I
Uh-huh.
have clients that want to go to credit union. Yes, they give you good rates, better rates than most, but however, they're more not guaranteed.
Yeah.
Or they can cancel your last minute.
That's true. I will say, well, you mentioned the point the last moment there. Stability is one thing. So Wells Fargo, B of A, Citi, you know, Chase, very stable institutions. That's a fact. I wouldn't say that any one is more stable than the other. We're very large, with a lot of deposits. It's just a stable environment when it comes to that. Credit unions, the smaller institutions, can run into the liquidity issues. So they may get to a point like Golden One did a month and a half ago, where they said, we're not doing portfolio lending anymore. Cut off, done. Many of our, you know, colleagues had gone there because they had a very good pricing. They had really open guidelines. I mean, we were losing a lot of deals to them because they were aggressive in pricing on their ARM products. 30-year was not good, but their ARMs were very good. But then you see what happens is they lent too much money out at too cheap and they had to shut it off basically. So if I'm looking at the big banks, which we are going to be somewhat in line in many areas. This is a big one because none of them do this. The others all take the lower of the two FICOs. We're going to use primary, like I mentioned earlier, primary wage earner FICO. That's a differentiator between the other big banks. You have a situation where, again, like I said, one customer's got a 650 FICO, one's got an 800. Every other institution's gonna use the 650. That may mean no loan at all. Where if this person makes more money, we're gonna use 800. So that's one that you always want to check with us on and say, hey, I got this situation, we got declined because this borrower's FICO is, you know, under 700, but the other one makes more money and the FICO is better. We should take a look at that. The 3 trade lines is also a differentiator. I think every other large institution like B of A, Chase, they require a certain amount of time the trade lines are open, a certain amount of activity for it to be, you know, credit sufficient. For us, we just need 3. Okay, opened a month, a year, whatever. Just 3 trade lines in the credit report. This one's probably a differentiator too. If you have customers with $1 million, because that discount is massive. So that really helps a lot from a pricing perspective for us. Is a big differentiator. And
I have quite a few customers right now, saving 1 million of combined asset of stock, retirement and cash. And today they get 5.75%.
yeah,
It's market the lowest, the best interest you can get for the high net worth funds.
mhm,
And also the 100% stock value will count 100% of the face value. The other banks always count 70% or 100% if you liquid all the stocks. And they require this before final approval.
mhm,
We don't.
yeah. And I would say on top of that is our ability to do exceptions as an institution, where most of our competitors have their guidelines set. If you don't meet the guidelines, you don't get the loan. Where we have the ability to look at the individual borrower and say, okay, well, they don't meet this guideline. They have 4 compensating factors, like that they have a ton of reserves, ton of experience in their industry, something where we can look and say, you know what, they might deserve an exception, even though they don't meet this guideline in particular. So that's, I would say, is a big one for us, the ability to do exceptions if it warrants it for the customer. Outside of that, you know, as large institutions, the bank is always trying to figure out the right pricing for mortgage. to continue to make money, be competitive, manage risk. And so you will find the different institutions at different times have more competitive rates, and it does this, depending on how many loans they want or need for the portfolio or don't want or need for the portfolio. So, not a bad thing to have a customer reach out to different institutions and get pricing to compare. Because it does shift based on the economics. But I would say that, while we may be more conservative in many ways, it has carried the bank through tough times, and remained profitable and stable because of that. So, working with us, the customer's in good hands. We're gonna do what's right for them, not just give them a loan because we want to close the deal. So, any other questions?
So the $1 million can be used for down payments.
No. So yeah. So if they're moving million over for pricing, what happens is we submit to our pricing. There's a verification deposit team that will review submissions for pricing purposes, right? For the relationship pricing. If a customer moves money over for pricing, they review it, they put it into the system, and it shows up in a screen for us. Here's the $1 million for relationship pricing. The system will automatically first use that money for down payment until we tell it, no, they're using these accounts at Chase or B of A that have already been validated by the underwriter, bank statements, we've seen the money. We put into the system, said, okay, these are approved assets that you can use for down payment and closing. And if the customer tells us, which we'll log in communication, they said they're going to use their Chase and B of A, which let's say has 500 to 500, in the system, we'll tell the system they're using these accounts and not this one. But the only way to do that is to have those accounts approved in the system by an underwriter. They've already verified they have the funds, and then we can reallocate. So again, like I said, now at the end of the day, do we make the customer show us that they use the B of A and Chase to wire the money in? We don't. It's on our system at that point, but we have to at least make sure they've told us that they're going to do this, and we log it, and then we approve those accounts for the system so that we can actually in the system show that they're going to use that money. But like you said, there's nothing we can do at the end of the day if they, take the money out, because some customers do. But I think for the most part, it's been successful for the bank. People have kept their money there, and we can use the, investments or cash. So, a good question. Anything else? All right. That's all we have for you today. We do have some sandwiches and water in the back. If you're hungry, please take advantage of it. And thank you for letting us come and talk to you.
How fast is turnaround time?
Oh, that's a great question. I like to phrase that as turn times for each department. So like we get a loan in from the customer, right? We're gonna tell the customer, here's what it looks like we need from you. And when they do the initial disclosures, as soon as they do those, we're gonna submit to processing. Processing is gonna grab the file and review it within 24 to 40 hours, would you say typically? So they'll look at it and say, okay, based on what I see in the file here, hey customer, here's what I still need from you, okay? So the reason I frame it like that is the turn time is as quick sometimes as the borrower gets us what we need. So if they get us what we need that day, then the processor will review it the next day again, and if it's ready, they'll submit to underwriting. Underwriting is 1 to 2 days, right? So we are closing a lot of loans under 20 days right now.
Actually, I can close it like 50 days,
50
sometimes
days.
like 10 days until under federal approval.
So most important thing too is if the customer is going to possibly work with us, is that we submit the pre-approval before they're in contract, because then we can get the thing fully underwritten. Without a property address, we can get it through underwriting. They can approve it, so you know exactly what the customer qualifies for. And then when you get into contract, that's where we've seen 10-day closes. They've already been approved by underwriting. They get into contract, we order the appraisal. Appraisals now are so much better. Yeah, we talked to you 2 years ago, it's like almost 30 days for a purchase to get an appraisal. Now it can be 24 hours. I mean, we've had some where they went out the next day and it's done. No one even knew they went, it's over. We also, what I think might be different than most is on our appraisal product, depending on the property, our system will determine the minimum appraisal product. And it may be a desktop or even our jumbo where the appraiser doesn't have to go out there and inspect the property, depending on, I don't know how they designate it, but information and systems will sometimes spit that out. Sometimes the full, but we have the ability to have more minimal products as well for the appraisal. So again, yeah, like if everything goes right, 15 days can be done. Yeah, it's quick right now. Good question though. Anything else? All right, thank you everybody. Appreciate it.
Oh,